Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy with all your monthly ETFs. And today we've pulled it all together. We've updated one of the sheets that we've done almost 7, 8 months ago. And that is the top 8 monthly income ETFs ranked, highest yields and the strongest total returns. As you know, I always watch the total returns and keep an eye across the board. So we're going to look at yields, we're going to look at our income, and we're going to look at our total returns to see which funds are actually working the best. So grab your cup, fill it with your favorite beverage, sit back, relax, and get ready to find out which are the 8 best funds that I feel are part of our retirement portfolio and retirement package. Hey, important disclaimer, the content is for educational and entertainment purposes only. This is not financial advice. Past performances do not guarantee future results. Hey guys, don't forget about our 40-ounce travel mug. They have arrived. They're in our doorsteps. They are ready to go out the door. And if it's anything like what happened with the coffee mugs, you guys ate this stuff up and we had to reorder 2, 3 times real quick to be able to fulfill the quantities. So don't be afraid to order this. Everything helps support the channel, and I appreciate it. If you bought one of the coffee cups, if you bought one of our license plates, I appreciate it so much. It helps the channel tremendously. Hopefully you can see the improvements in the videos. But if you need something for your car, travel around, this is the awesome piece to have. Remember, I got it, and it's primarily because I broke my cup going to my truck. So now we have these in great shape. So let's go with the selection method that we talked about. Number one, it must be a monthly paying dividend. Okay, I'm not looking for weeklies. I'm not looking for quarterlies. I'm looking for monthly pays. It has to have a minimum of 12-month history. So any of the new funds, everyone's going to say, oh, what about this fund, this fund? They're probably not in here because they haven't been here for over 12 months. But don't be afraid. If you find one that you love, don't be afraid. Put it in the comments below. We'd love to hear from you. Because I read every one of them. May not respond, but I try to read every single comment that goes in there. Number 3, data. Distributions versus total returns. So we're not just finding the highest distribution, we're trying to find the best total return package across the board. Now, I did exclude leveraged ETFs. I've excluded single stock ETFs, and I excluded all the crypto funds. I am not a big crypto person. I don't think I won't go there. I won't even go talk about it. I won't do in the crypto. Single stocks are very, very risky for retirement accounts and leverage as well. So this is our list. This is how I put this thing together. So Doug's golden rule. Yield is a math number and it does not tell you anything of a fund's health. So chasing big giant yields is a no-no. You can't do that. Yield is a mathematical number. Once you get that number, you go look at total return and I can almost tell you, are you having growth or are you not having growth? Is it a true number or not a number? Total return is the driving factor of every fund across the board. That's why we will always put more empathy into the total return than we do just yields. Let's take a look at number 8. Number 8, SPYI, the NEOS S&P 500 High Income ETF. So at number 8, the distribution rates came in at 11.99%. Total return, 19.02%. So if you can do some simple math, you can always take our total return minus your distribution rate to tell you has the fund grown or not. Well, over the past year, you're seeing about a 7 to 8% growth on the particular fund. So if you invested $100,000 into this fund, your value would be about $11,990. But if you took your monthly paycheck out, you're getting about $99 per month from the fund. Now this one is a core income piece and it's in the larger cap. So the core exposure is the broad S&P 500 exposure. Now they do some great things with the tax advantages with the S&P 500 1256 contracts, a little bit of ROC, a little bit of tax harvesting, a lot of pieces to do in the tax side of it. It optimizes the tax loss harvesting part of it to help offset those capital gains. The upside potential is designed by providing high income but sacrifice some of the gains in powerful bull markets. So this one is strong. It's doing several things reasonably well. It's not winning only in one category. It's a solid candidate for your core income bucket, especially with the S&P 500 segment of it. Number 7, QDVO, Amplified CWP Growth and Income ETF. Now, this is a monthly income strategy report. Number 7, QDVO, giving you distributions of 10.69. Now, the total return came in at 20.60. So you got about a 50-50 mix here. You got about a 10% growth, 10% distribution for a total of 20% total return. Now, this one here is going to give you an $891 monthly income. So it really, again, you can show it right off the bat. I'm not leaning towards yield because the last fund, number 8, was higher than this one. But I'm really watching total returns is what we want to watch. So if you had this fund with $100,000 invested into it, you're looking at about $891 a month payout. The strategy, it concentrates on the large cap growth profile, earnings, and cash flow. It's tactical cover calls on individual stocks and indexes, and it's a selective option covered aim to obtain more market upside. And you can see that in the total return numbers. So my opinion on this one here is a growth first income fund that sits beside a core holdings and is aggressive satellite. I don't think QDVO is a good satellite. I think, a good core. I think it's a good aggressive satellite for someone who's looking for income fund and that growth first idea. It's best for retirees who want to check out without giving up all of their growth. So at number 6, it's QQQI. Now I'll throw a few stinkers out there and some people will say, what are you talking about, Doug? You've lost it. Well, I believe that this thing ranks at number 6. It has had a good run. Distribution 1405, 1 year total return 25.99. So you do see that it has some growth to it. Hypothetical, basically collecting yourself a $1,171 paycheck off of a $100,000 investment. The growth focused strategy, it's an active options management. Okay, this is where they're buying the NASDAQ 100 in stocks. They're also trading their options on the NASDAQ index. So, that's what controls. They're getting more income than you're getting growth across the board. Now, I believe still that this thing is best used as your NASDAQ oriented core. It's for retirees who want high monthly checks but are willing to give up the massive growth potential of the NASDAQ 100. This is where I would say this is your incomes version, and then you could always add in a growth satellite part into this to make it really work. Number 5. I know I'm going to hear more and more as we go through this as well. But here we go. GPIQ, Goldman Sachs at number 5. 10.50 distribution, 32.32% over that 1 year total return. Hypothetical, if you had $10,000 or $100,000 invested into it, you're basically collecting $875. Now, I will give these guys an award for having the lowest the net expense ratio. Now, I do have noticed that they have planned in, I believe it's April, don't hold me to that exact date, but April, that they're talking about having an increase in that 0.29 up to 0.35. Now, I like Goldman Sachs with the way they do their option writing, where they're using the flexibility of that 25-75% based off the market conditions. So if market conditions are, just grow, they'll lower it down to 25%, only cover partial of their portfolio. If you see its volatility, they'll go up to 75%. We've seen a lot of difference in the program lately, and they're starting to see some real good upside of this particular fund. Now, here's the thing. This is a prime candidate for a growth and income satellite. Now, if that doesn't get a lot of comments down below, I don't know what I'm going to say. It's going to make things different. This is a tough one to play, and I'll tell you why I'm thinking it through. I would put this in as a growth and income satellite with my QQQI as my growth entity. Now, a lot of people can say, whoa, not wrong. This could be a core. In some portfolios, this could be a big core for them. So I like it. It can go both ways. I just do the math myself. I like QQQI. I like GPIQ as my core of my NASDAQ 100s. And I'm pretty well set to two phenomenal companies doing great jobs. If you care about keeping pace with the NASDAQ leaders, but still want that 10% paycheck, this gives you more of a balanced play. And I've said that many a times. Number 4. EGGS, the Nest Egg Total Return Guard ETF. This one here does not get enough press. It's done tremendously well. I'm going to say a couple things positive and negative about this. One, 21.37% distribution rate with a total return of 26.5. So primarily heavy on the income throttle, not as much on the growth side. But if you had $100,000 invested, you're talking a $1,781 monthly paycheck. The strategy highlights it's a concentrated portfolio of 10 to 25 high conviction holdings. It's a selective cover calls to generate that monthly cash flow and the tactical hedges on specific positions and broader indexes. It targets that monthly income with a measure of downside protection. And I think the downside protection is one that added me to the list saying, this is probably going to boost us a little bit along with that total return numbers. Now, I will put this as a very aggressive income satellite piece. Okay? The concentration risk is what scares me, if anything, of how they've only concentrated down to that 10 to 25 particular pieces. I like the S&P 500 having a broad brand over 500. I like the NASDAQ having the top 100. But when you get down to 10 or 25, man, I got to play and hope that Nest Yield really picks the right pieces. And so far, they show that they have. Also, their expense ratio is a little on the high side at 0.95. And this thing launched in December of 2024. So we're playing with a little lack of history. But I will give it positive having active managements across the board. Number 3. Number 3 is one that I'm hoping everyone had in their portfolio this year because I'll tell you what, the Russell 2000 has gone gangbusters. They've done a great job with it. So the IWMI from NEOS, it's ranked at number 3. Distributions of 14.42%, which give you a paycheck around $1,200 per month off of $100,000 invested. 1 year total return 35.91%. Now that was reported through June 30th, so I know we're a couple weeks off of that, but really give you a hardcore number. The Russell 2000 small cap exposures paired with an active managed index option strategy and provides a diversification satellite that behaves differently than the S&P 500 or the NASDAQ 100. It's designed to capture the small cap growth while generating consistent monthly income. The small cap risk factor is high volatility, weaker balance sheets, and sensitivity to borrowing costs. Earnings are less predictable than large cap peers. But IWMI is a fantastic tool for a broader market exposure. But remember, small caps are volatile. Don't extrapolate a single excellent year in favor of just grabbing this fund. If you're looking at saying, oh my God, they did a phenomenal year, I'm adding it to my portfolio, I highly recommend this one as a core to the Russell 2000. I'm okay with that. But in my portfolio and income side of it, Russell is going to be down more to that 10 or 15% of the portfolio versus a 20 or 30% you'd see at the NASDAQ or the S&P 500. So it's not as big of a piece, but man, it gives you some good returns when they have a good type of year. Now at number 2, EGGQ, Nest Egg's Visionary ETF. Now this one got number 2 for really a couple different reasons. And I'll tell you right now is that 1 year total return at 55.37%. Now distributions is the lowest in the group. That's why I said I'm not following yield. I'm not chasing yield. I'm chasing these total returns. So the distribution rate at 7.75% is the lowest in the group. So realistically, you're going to get about $646 per month if you have $100,000 invested in this. But this one's not for income. Okay? This is a critical lesson. Total return measures the actual happening to your money. Large distributions are not valuable if your share price falls by an equal or greater amount. The strategy on this one is the innovative US Large Cap 100. It's out of the money calls and spreads to retain growth exposure. As I said, this thing is designed for growth. The concentrated active management fee of 0.95 and the performance does not project forward. In the retirement role for investors who prioritize long-term wealth over stability or absolute largest immediate paychecks, this is the fun. What would I do with this one? Actually, this one should probably be in your growth package. Okay, this would probably be in my growth fund, collecting that 7% as a buffer, adding it to it for that total return number. But if someone also came to me and said, hey, I need more growth in my income side of it, this would be one that you could throw in there as a growth satellite. So realistically, I still like it in the growth fund under the total return satellite package as versus a income, but it made it to the income side because some people are using it for that. And at number one, I think this year alone has got to give it its award. EGGY, Nest Yield has done a great job with their packages this year. We're going to wait and see how they do in the later on history. So none of these I will classify as cores. I think you saw my cores, Neos and Goldman Sachs. And so EGGY, the Nest Yield Dynamic Income Fund. This one here is number one as distributions of 33.11%, total return 48.99%. Just a good, nice balance between the two. So you do have some growth with some heavy income. This one here would pay you $2,759 from that $100,000 investment. It's a concentrated portfolio again. It is the downside of these that I know what they're doing. I just not 100% comfortable all the time for them to say it's a core. It's always a satellite. But it's at 10 to 25 high conviction holdings. It's a selective covered call strategy for monthly income, targeting the downside hedges to protect your principal. I do give them that credit that they do look for that downside. It is a dramatic management aiming at 25% average yield. So they're trying to get you 25%. So that's why I can't argue with these guys. They're targeting a 25, and they've been doing good with that. But it is a relatively new fund, December 2024. There's no long-term history of how it's going to handle on downward markets or, bear markets across the board. The higher expense ratio and the concentrated risk. But overall, this is a high-income aggressive satellite. It's not a sole holding for anybody. I would not do it for that. This would be one that I would throw in there to boost if you need even more income for some particular reason. You could boost your income up with this particular fund. So the final rankings and the ETF scoreboard as we go. You can see either way you want to do it. You can look at numbers, you can look at the chart. But across the board, Nest Yield, I think, is doing a great job in 2026. My cores are still over here. I know they're going to be low rated 5 and 6. I almost feel like we're at the NHL or NBA draft at being picked at number 5, GPIQ, number 6, QQQI, number 8, SPYI. Man, those are my cores. Those are my cores have been there. But I will tell you, Neo's still doing a great job, getting 3 in the top 10 and the top 8 with the Russell 2000. But Nest Yield's really doing some good numbers across the board, solid distribution rates, but real over total returns have been phenomenal across these funds. Hopefully you're invested into these. Hopefully this will help you. If you haven't been involved, I had a Patreon person call me and we sat and talked a little bit, and they were not into IWMI yet. They had everything else well balanced, and I said, hey, I think you need a little Russell added into this, and hopefully they added to it. But this is what helps people figure out fine-tuning your portfolios across the board. Hey guys, where these things all work, you remember my 3-bucket system. It's an important part of it. There's foundation, there's growth, there's income. I've talked about the growth side of it, talked about the income side. You need to have a core in each one of the buckets. You need to have some, then you can have some satellites to help support that. But just remember, if you haven't watched the video, definitely take a look at our 3-bucket retirement, simple, balanced, and built for life across the board. So my verdict, my ending to this is the core income sleeve, SPYI, QQQI, and GPIQ. I still think those guys are holding well, doing very, very well as your core. A diversification sleeve, IWMI, not afraid there, and your aggressive satellites are the nest yields across the board. So I just kind of guys give you where we sit, where everything sits at the eight different funds. I just think they all can work in a proper retirement package. Like I said, the 3-bucket system. Let me know your thoughts. Leave a comment below. Hit that like button. So here's my 4 questions I want to close with is before you buy, is the distribution sustainable? Is the NAV stable and growing? What's the complete total return? And how much risk is being taken for your income? These are the questions I have to ask because that's what I did with all 8 of these when I started to rate them of where we put it. Remember, the goal is not to be the biggest check this month. It's the goal is to have a retirement paycheck that continuously pays year after year. Again, thanks for joining me. Don't be afraid to hit that subscribe button, hit that like button, and most important, don't forget about our 40-ounce travel mug. Thanks, guys, and we'll catch you at the next video.